Hello ICT traders, 2 Degrees here, and today I want to show you how I personally use the average range levels pro plus. This tool is the advanced version of my Judas and daily range meter, and it builds on top of the ADR concept to have a weekly and a monthly equivalent. But let's start from the ADR first. ADR stands for average daily range, and the ADR is a commonly used metric in retail trading to measure volatility of an asset. It is calculated by summing the range of a previous number of days and taking the average value. Usually the ADR is calculated over the past 5 days. ICT teaches us the importance of this metric from an algorithmic point of view. And in particular, he brings our attention to the 1/3 ADR level. Now, what is this 1/3 ADR level? And for that matter, what is this ADR level down here? The difference between how the ADR is used in retail and how ICT uses it is that he anchors it off of the midnight open. So from this open right here, we're going to project downwards and project upwards the current value of the 5-day ADR. So you see that number up there? We're going to take the open of the day plus this number and then minus that number to get these two levels. The 1/3 level, trivially, is the 1/3 distance to the full ADR level. Now, why is the 1/3 level important? So ICT tells us that in particular, this level is deemed to be the threshold for a Judas swing, so a manipulation or a protraction move. And in particular, it's a level where the algorithm is willing to go to at max for a Judas to be valid. An important factor to keep in mind is that the time at which this level is hit is very, very important. If we're going to see a Judas move, we want to see it towards the earlier part of the day rather than the later part of the day. Let's take the example of a open low I close candle. The Judas, which is going to be this move right here, the protraction of the day, this being a daily candle, is going to be in the earlier part of the day. So if this is time, we're going to see this Judas move towards the beginning of the day. If we split in half, we should kind of expect to see it before 12. What we can see here, for example, is we're on EU today. This is light price action, and we've hit this 1/3 level at 9. And we did have some red notice news at 8:15. So the news might have been the reason for this protraction, this final move down here. And although we didn't quite raid liquidity, we got pretty close to it. This level now is something that I'm paying attention to. I want to see how price reacts around this level. This is because we could see this being the bottom of the Judas move. So the price from here could reverse and start moving higher towards higher levels or towards some buy side liquidity. This tool can be really, really strong if you have a clear drawn liquidity in mind from a higher time frame perspective. I do see these relative equal highs here, which are a pretty obvious liquidity zone for me. So I wouldn't be surprised if we perhaps rated this low, maybe having a little bit more of a move below here and then rallied up to this level. Now, what you can do with the average range levels pro plus is that you can have the same equivalent for the day, but for a week and for a month, meaning you're going to have the same concept, but applied to multiple time frames. What you get then is levels for the month, the week, and the specific day we're currently trading in. And this is really handy because you can cross-reference these 3 specific sets of levels to add even more confluence. Again, this tool should be used for confluence. Using it on its own is quite difficult if you don't have a clear liquidity in mind. In this specific case, for example, we can see how although we just hit the 1/3 ADR level, so the daily level, we're pretty close to the weekly level as well. So I wouldn't be surprised to see the weekly level also offer some sort of a rejection. And if it doesn't, and we trade through it, it's also a great indication that maybe this area could act as an inversion level and we can move lower towards the full ADR or perhaps even the weekly level. And as you can see, that's exactly what happened. So we were talking about this little move, we traded through it. And then if we go to lower time frames, we can see how after that little move up, we went below it, used it as a little bit of a resistance, dipped into a fair value here, and then moved lower. Let's go back to just seeing the ADR and let's start talking a little bit about data. Let me turn on the historical ADR levels for the 5-day ADR. Now, right away, you can see how these levels are very, very strong. And again, these are just the daily levels, but the same thing applies for the weekly and the monthly levels. And you'll notice that there's repeating patterns and repeating behaviors with these specific level types. We have 3 types based on the data that I collected. We have clean rejections, such as this one, where at a specific time of the day, a significant time of the day, in this case during a kill zone, we hit this level and we see a rejection right away, and we move with displacement away from it. We have a consolidation around that level, from which we either displace in the opposite direction, or we use the level as an inversion to continue, something like this, but perhaps this is not the cleanest example. And then the third example is something that resembles this consolidation where it's not really a given that we'll hit these levels, right? So we might just consolidate between the two and hit neither, or hit this and not really have a crazy reaction, but still holding price. Now, the other cool thing about these specific levels is that while we have demonstrated that these levels are very significant and also that they act more so as an arrow than a specific price point, another cool thing that we can do with these daily, but especially the weekly and the monthly levels, is that we can use the ranges defined by these specific levels as implied ranges. Now, what does that mean? It means that if yesterday off of Euro USD midnight open you were bearish, you could have traced your OTE using these two 1/3 levels, and you can see how the OTE level got respected right away to then give us a great setup into London kill zone to reach the minus 1/3 ADR level. You can divide this range as you best see fit. You can use OTE, you can use quarters, almost like you're grading a swing. So you can see how these quarter levels are also very significant inside of these ranges, or you can also use them for standard deviations. And it's me from the future again. You can see how we can use any of these specific implied ranges as ways to get specific levels. So here, for example, if we use this, we use the 6-2 level of the OTE as a reversal point to then get this little retracement that we're currently going through right now. Tying it all together in hindsight, we can see how we hit the OTE of this first range, this first implied range between the two 1/3 levels of the ADR. We reached one of the two levels. We had a little bit of a bounce. We broke through it, confirming this PD array. So this premium mitigation block right there. We went back into that level, rejected with displacement, and we landed at the OTE of this specific range between the 1/3 ADR and the full ADR level. And we're seeing the retracement right now. And when earlier I was saying about the standard deviation is that to me like this, then we can get a great point where to pull the standard deviation from. So you can see how we got basically to the tick to the 2.5 standard deviation that then initiated the retracement from this little move up here. Now I moved to NQ very quickly to show you another thing that you can use this tool for, which is comparing correlated markets. Here we have NQ to the left and the Dow to the right, so YM right here. And as you can see, they both traded through the 1/3 ADR level and traded back up with displacement. That was very energetic coming back up. And this could tell us that we might see a continuation up due to this displacement. However, since we broke this level below, and we've almost basically invalidated the idea that we could have a bullish Judas swing happen, when we see this SMT up here, we had even more probability to the fact that price is going to reach for lower prices and perhaps even this lower ADR level here on NQ. Which one of the two is the weakest asset off of this SMT? It's going to be NQ. So we wait for news hit, and then we trade price accordingly, having this bearish bias for the day. So in a nutshell, comparing correlated markets with these levels and see when they get hit and how they react to it and what price action does after these levels are hit or traded through can give you a great idea of daily bias as well. This is with the ADR, but obviously all of these concepts apply with the weekly and with the monthly average ranges as well. These are even more powerful because imagine if you could get the direction of a week in advance so that you can anticipate price on a weekly perspective rather than a daily perspective. Depending on the type of trader that you are, even if you're intraday, this could really help you. See how Dow here, for example, hit the higher 1/3 level of the AWR while Nasdaq didn't, and see the reaction that it had from that. So this was your Judas for the week on Dow. Notice how at that time on the left, Nasdaq was completely in a different place. That's your SMT. Which one of the two is the weakest pair? And Q is going to be the weakest pair. So off of this day, from this day onwards, you can be bearish for the week, or at least leaning to a bearish bias if the higher time frame narrative is aligned with that as well. Let's go back to the DR again, and I want to show you the last piece, which to me is like the most important part of this whole thing. And let me show the historical as well. And the most important thing to me is this table. Let me make it a little bit bigger. Now, what is this table and what does it show? You're going to have 2 rows of data for each of the 3 types. This is for the ADR specifically. The top row is going to be your actual daily candle ranges. So the current daily range and the previous daily ranges. So the previous 5 days. Whereas at the bottom, you're going to have your ADR for the current day and the previous 5 days or 5 data points for the average daily range. If we see days where the daily range was below the average range, then we can categorize those as consolidation days. ICT tells us that after consolidation days, we can expect expansion days off of month 1 of core content. And specifically, if we have a very small ADR level, we can expect to break it. Now look at these 2 days right here. We were much below the average range level. And on the current day, we went much above. So after these 2 consolidation days, we can expect an expansion day right there. This idea works for all the different types of ranges as I mentioned. So you have the dailies, you have the weeklies, and you have the monthlies down here as well. If you can cross-reference these, you can easily anticipate when you're going to have a daily expansion, a weekly expansion, or a monthly expansion. On top of that, you can use this data to define your daily, weekly, and monthly profiles. If you see consolidations at the beginning of the week, meaning the daily ranges don't go over the ADR, you're going to expect an expansion, which is a potential Judas swing for the week. You're going to double check it with your weekly levels, and from there, you're able to define your bias for the remaining of the week. I hope this was helpful. I'll leave the link to get access to this specific tool in the description below, and if you have any other questions, feel free to drop them in the comments. Thank you, and I'll see you soon.